Hey there. If you're living in Georgia, South Carolina, or North Carolina, you already know that owning a car is a pretty big deal for your budget, right? Between that monthly payment and the insurance bill, it can feel like your wallet's taking a serious hit. Well, today we're going to change that. We are diving deep and tackling the high cost of car ownership head on. When you think about where all your money goes on your car, it almost always boils down to two things: your insurance premium and your car loan. These are the big ones. You've got to have insurance to be legal, and most of us need a loan to get the car in the first place. But man, can they be confusing. So, what if I told you that you could slash those costs? And I'm not talking a few bucks, I mean hundreds, maybe even thousands of dollars a year. The good news is you totally can. You just have to know where to look, because the rules and the rates are a little different depending on which state you're in. Okay, let's get right into it. For this explainer, we are using real hard data for Georgia, South Carolina, and North Carolina. And it all comes from our source, myfinancialprograms.com. So this isn't just some generic advice. This is a guide tailored for your state to help you save some serious cash. Here's what we're going to cover. First, we'll check out the basic driving costs and rules in the Southeast. Then, we'll break down exactly how to lower your car insurance. After that, we're going to hunt down a cheaper car loan. And we'll wrap it all up with a simple action plan you can literally start using today. All right, let's start at square one. Every state has its own minimum insurance rules, and these laws basically set the starting line for what you're going to pay. Understanding them is the first step. So Georgia and South Carolina both use what's called a 25-50-25 rule. Now, what does that even mean? Well, it's about liability. That's the part that pays for the other person's car and medical bills if an accident is your fault. So it's $25,000 for one person's injuries, $50,000 total for everyone's injuries, and $25,000 for property damage. But then you have North Carolina. Whoa. They recently cranked their minimums way up to $50, $100, $50, giving their drivers the highest property damage minimum in the entire country. It's great protection for sure, but it also means the starting cost is just naturally higher. Okay, let's move on to the biggest piece of the puzzle, your insurance premium. We're going to pull back the curtain on how that number gets calculated and show you the one thing that has the biggest impact on what you pay. Just look at this slide for a second. This says it all. Check out these monthly costs for full coverage on a new car. Whether you're in Georgia, South Carolina, or North Carolina, the difference between having excellent credit and below fair credit is absolutely insane. In South Carolina, you're paying more than double. And in Georgia, it jumps from $262 to almost $600 a month for the exact same car and the exact same coverage. Let's just visualize that for a second, because the impact is huge. We're talking about a difference of over $300 a month in Georgia, just based on your credit score. That is a massive penalty. So the takeaway here is crystal clear. The single most powerful thing you can do to lower your insurance bill, no matter which of these states you live in, is to work on improving your credit score. Now, let's talk about another risk out there on the road. This right here is the percentage of drivers in each state who don't have any insurance at all. And you can see the risk in Georgia is especially high. We're talking nearly 1 out of every 5 drivers has no coverage. That's why having uninsured motorist coverage is so important. If someone without insurance hits you, your own policy won't pay for your car or your medical bills unless you have the specific coverage. It's a lifesaver. Okay, for all of you driving a used car, here is a fantastic little rule of thumb. It's called the 10% rule. So collision and comprehensive, that's the part of your policy that pays to fix your car. Here's what you do. Figure out what your car is worth right now. Then look at how much you pay for just collision and comprehensive in a year. If that annual premium is more than 10% of your car's value, it might be time to drop it and switch to liability only. You could be paying more to insure the car than it's even worth. All right, we've gotten a handle on insurance. Now let's switch gears and talk about that other huge expense, your car loan. Whether you're buying a shiny new car or a reliable used one, where you get your financing from, well, it makes a huge difference. So you found the perfect car and now you need the money. Where do you even start? Do you just go with the dealership's financing or your bank? An online place? Well, the right answer really depends on one thing, your credit score. So let's look at the data for someone with fair credit. Across all 3 states, Georgia, South Carolina, and North Carolina, the pattern is pretty obvious. Credit unions almost always offer the lowest rates. Why? Well, they're member-owned nonprofits. Their whole goal is to give their members, that's you, better rates, not to make a huge profit. The dealership might be convenient, but for most people, it ends up being the most expensive option. And this is where your home state really starts to matter. For new cars, you're in pretty good shape no matter what. All three states have average rates that are actually below the national average. But when we look at used cars, the story completely changes. If you're in Georgia or South Carolina, you can expect to see rates that are higher than the national average. Meanwhile, North Carolina stays pretty affordable for used car loans too. This tip from the source material really just nails it. The bottom line is, if your credit score is anything less than perfect, your first stop should be a credit union. Yeah, a dealer might have some amazing promotional rate if your score is like 750 or higher, but for literally everyone else, the credit union is going to be your best bet. Okay, we've gone through the rules, the insurance hacks, and the loan secrets. Now let's put this all together into a super simple checklist you can use to start saving money, like right now. Getting the best loan rate is a simple four-step mission. Step 1, know your credit score before you even think about shopping. Step 2, get pre-approved from a few different places, a credit union, your bank, maybe an online lender. Step 3, walk into that dealership with your pre-approval letter in your hand. This is your superpower. It gives you all the negotiating power. And step 4, pick the shortest loan term you can actually afford. You'll pay way less in interest. And for your insurance, here are 5 quick wins. First, shop around for quotes every single year. Second, bundle your car insurance with your home or renter's policy. Third, ask about every single discount you might qualify for. Seriously, just ask. Fourth, think about raising your deductible from $500 to $1,000. And finally, and we've come full circle, work on that credit score. It is the biggest lever you can pull. Look, we've only just scratched the surface today. If you want to see all the data tables for new and used cars, get more guides specific to your states, and find a ton more tips, you can find everything at the source for this explainer, myfinancialprograms.com. So, there you have it. You now have the playbook. You know how the system works, and you've got real concrete steps you can take to save hundreds of dollars. The only question left is, what's the first move you're going to make?